Hi, in this video I'm going to show you how to use Fibonacci. It's a question that comes up quite frequently. It's something I used to use a hell of a lot until I come across pivots, but I still use it occasionally, and they certainly got their place in natural trading markets. Now, you can go out and cherry pick particular examples. There'll always be an example which will come up to a Fibonacci number absolutely perfectly. But firstly, I'm not going to go through what they actually are. It's a sequence of numbers effectively that was derived by adding the first number to the second number to the combination. So 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5. Then you next move on to 8, 13, 21, 34, etc., 55. So you're just adding the last two numbers together. You then, if you do a division, let me just bring a calculator in here. If you put like 21 divided by 34, for example, the next two numbers, and you get this number 6176, 61.8, and it works from that sort of number onwards. All the numbers come to 61.8. You can start pushing those numbers across from everything from the pyramids to the human body. It's a scientific number which has a lot of relevance right the way through the markets within nature, so they can pin lots of things onto these numbers. Anyway, in brief then, how do we use it for trading? Well, there's two aspects. There's retracements, and then there's extensions, which are most commonly used. Now, I haven't got a drawing tool on here as such. What I have, a retracement would be, he's going to have to quickly adjust this, so we get rid of the extended right, that's it. So a retracement is from the high up there to the low, and that's the retracement. So Fibonacci used in retracement. So you'll see the tool if you're using TradingView. It's over on the left hand side here. It defaults, I believe, to fib retracement, but there's a whole pile of different fib things that you can lose yourself in for years. Don't do it. Just stick with the basic fib retracement and maybe fib extension. So we'll look at those in some more detail. But so this is a fib retracement. Common numbers, actually. Let's just bring it up. So we're going to pop it on this one here. We'll pop it down to the low. I'm just going to drag it a bit beyond it so we can see where it pops. There we go. So common numbers there then is 2.36, 382, 5, 6. There's your magic. There's the magic number, the golden number, 61.8. 786, 86, 886, and 941 are just square roots of the 618. 100 minus 61 minus 61.8 equals 0.382. The middle of those 2 points is 0.5. Not genuinely a Fibonacci number, but it's there, and ironically it's the most common factor that comes in is 50%. Often you'll get 61%. Now, in a normal market terms, in terms of retracement, any sort of significant retracement must come past the 23.6 and often up to the 38.2. So when I'm looking for a way of taking a short, so if I'm looking for shorts in this market, it's been trailing down, for example, what I'm looking for is a point at which I might be looking to sell it if I can find some resistance. Now, it might be horizontal resistance. I like pivots, so it may be pivots, but I might look at some confluence. So I may put the fibs on there as well and just look. Some people just use the fibs, they swear by them, but well, like anything, pivots, fibs and everything else, price doesn't mean to say it's going to stop there when it hits it. So you've got to be a bit careful. And what's stopping it from going to 38.2 and rolling, or the 50 and rolling, or the 61.8, or you can see what I'm saying here. There's no guarantees. It's just that they come quite a lot. The period between 50, I refer to it as 50 or 0.5, it's showing on here, but we refer to it as a 50%, which because it is 50% retrace. If we're looking between a 50 and 61.8, that is the the trading zone, if you like. You get quite a lot. The fib zone, I refer to it as where you get quite a lot of retracements, not necessarily on the button, but I mean, this is amazing. It's the euro, it's right up to time. You can see the time, that was Friday at 1800 hours when I recorded this. There's nothing on the end of it, it's not cherry picked, and we'll look at the other movements in this in a moment. But for now, you can see there, so there's a retracement. How you might use it then, how to use it? Well, looking for retracements. Do I just use it? Would I just use it on its own? Not if I wanted you to trade successfully, for sure. If I wanted to con you into the idea that Fibonacci are wonderful and you should just follow them, yeah, just sell it. No, is the answer, because as I've already said, we don't know at what point they're going to stop. All we can look for is some confluence. So how you use it is look for the confluence. If you've got some, for example, I don't know if I've got any pivots sitting around that level. What time period? Let's have a look on the weekly. Let's just pop the weekly on there. There's nothing there. Is there a quarterly figure around that area? Nothing. Is there a monthly one? Nope, nothing in terms of pivots. But saying that, I don't even need to look at pivots here, because there was these two previous lows there, so it's just really come back up to support. So it's using support as resistance. So you've got a point there which you could be looking to sell from at some stage. Some traders will put their stops up to the next Fibonacci number. So for example, if you're doing a 50% retrace, you might look at the 61.8 as a minimum point for your stop. Others will look maybe at 786. It has the more it retraces, the less likely it is to get to the numbers. So a 786 is got a lesser probability of being seen than a 61, a 50, 38 or 23.6, obviously. So it's not an even distribution of any of those numbers. It's less as it retraces. So you can, as I say, simply use the fibs if you wanted to as the next point of support, the stop places. So for up here, for example, I've not got this perfectly on this. Yes, I have, but I had anyway. Up here, you got a high. Obviously, you got the high anyway, so you'd be popping it across the top. But it's probably not the best shorts to be going when you get to this point. There's some studies being done which says if it goes point set past 78.6, well then it's as good as dead. However, of course, the 886 and 941 lesser used fibs, they work. The 786 works particularly well on the S&Ps. If you go backwards and forwards on it, you'll find it has quite a strong relationship, and you may find your markets do that. So I've identified the retracement. We looked at how you might use it, looking for it with some confluence. Don't ever use it on its own. You could use it from different levels as well, and this is where there's pros and cons of everything. I mean, what's wrong with taking the high from up there? Why choose that high? Well, then you could be looking right the way across to this low for this current position here where it's moving. Well, that's going to be a 50% retrace of the bigger move. But the problem, as I say, with fibs is the placement. I mean, okay, when it was back here, I could have used that high there, and sometimes you get a lot of overlap. Here you haven't, so it's not that relevant at that stage. So let's get rid of these for the moment. Take that one off, take that one off. So you can see the retracements that you can, as I say, the downside is, well, which high do you put it on? Because you could actually go right the way back. I tend to look back at the very high time frames and look at what's actually going on with this movement. And the real point of it from here would be that high there to the low here, arguably, to see how far things are retracing on the bigger scale of things. But it depends on the time frame you're trading in. If you're trading on this 4 hourly, if you was back and the market was looking like this, well, there would be an opportunity to be looking at, well, okay, yep, 50% retrace previous lows. There may be an opportunity to sell. I wouldn't sell directly onto those points. I'd wait for a retracement bar at least, and there it is, the retracement bars occurred. So That's one way of using them, and also the pitfalls of needing a particular high or low. It will vary. So, right, the next point is Fibonacci extension. So this is where we look for targets, and I might as well use this example. It's not the best because it hasn't done what I'd like it to have done, so I haven't gone out and cherry picked one here. Let's before I do that, let's just look at the principles behind, say, a flag. So you've got a downward movement, you've then got the retracement. That gives us the flag pattern. So there's your flag. Well, with a flag, you then would measure from the high to the low there, apply it back to the high, and that would be the expectation. So you're measuring from the top to the bottom, which gives you how many points that is. Let's just measure this one, pop it on there, down to the low there, 125 pips. So you would expect then 125 pips as a rough guide, and I say it's rough from there downwards, he says, down to here somewhere, and that would be your potential target on a flag. I don't particularly do that myself. You've got to be a bit careful. You're hoping for absolute precision, and there is no precision in markets, regardless of what people will tell you. So from there, you would measure this point to this point, apply the length of this onto this point here, and look to see how far it's gone. So I've got the fib extension here then, so I'm going to run it from the high there down to the low there and apply it to this high here. I'm just going to drag it across a little bit so you can see it a little bit easier. And now when I'm using this personally, I target a 786. If that was the flag pattern, I would be looking at a 786, but that would have even, well, it's potentially not failed. This could still roll over and go off and hit that 786, etc. Yeah, but you can understand how it can be used then. So you're looking at the same principle, same percentages. Look, so you got your 0, your 23.6, 38.2, 50, 61.8, 786. I haven't got the 886 on here with 1, and I've got some other multiples on here. These other extensions, there's some harmonic patterns out there, and they will use patterns like a 1272 extension, 1618 extension, so they're using the same numbers repeated as we go through. But you right away to 1618 or 2618, they run all the way through. Personally, I don't use them like that, but they can be used, and it doesn't mean just because I don't use them that they're not usable. So there you go. So that's the second way of really using Fibonacci. There's lots of other elements I've looked and studied over the period, and I was going to say time, and time is one of the things. You've got Fibonacci time. You've got all sorts of fibs that you can apply to a chart. The more you apply, well, you may find some confluence. You may just find points that fit the chart that you're particularly looking at, which don't necessarily work when it comes to trading them. They're not the easiest things to trade. Some people have a better knack at spotting them than others. Because I've just said they're not easy to trade. Some people think, well, you're just no good at it. Well, maybe not, but I did spend quite a few years cracking at it, and I still like, as I say, I still like them. I still use the principles behind them. As I said, I look for a flag. I'd look at a 786 extension from the high down there as a target, and so on. In this case, it got down to its 61.8. Maybe you would move the stop to break even on your plans at 61.8, or when it's got down to its the previous low there, you'd move stop to break even. Lots of different ways of trading it, and what I'm really referring to then is how you're trading a flag as opposed to how Fibonacci extensions can be used. So just to clarify things, you've got your standard fib retracement, which will be from up the high here down, from the high up here to the low down here, and back into here. That would be your standard retracement. If you're looking for the extensions, well, then you're taking the high to the low, applying it to the high there, and looking at where it's going to go downwards. And I haven't drawn that one very well, so I'll just, there we go. So there we go. That's how extensions are used. Now it's only one way. There's many other ways. I've looked on the short side here because the market's going down. Obviously they work the other way around. And there's a lot of harmonic patterns such as butterflies and Gartleys, which I use Fibonacci on, and they work quite well. But again, you need some sort of confluence in my book to be trading those. I do like them as patterns. There's lots of patterns I like because they naturally work well, and many of them tie in quite well with Fibonacci. So there you go. This is how to use Fibonacci for retracements, for extensions. That's one way or two ways. Take care. Bye for now. Oh, by the way, if you like this video, please give me a thumbs up. If you like this sort of educational videos, do join my channel. Take care. Bye for now.